All right, we're talking about how to save money on your taxes with tax planning strategies that enable you to apply the Internal Revenue Code, the tax code, as if it's a treasure map to increase your after-tax wealth. So let's dive in to our fourth and final video on this topic of tax planning strategies. Today we're talking about conversion, or converting bad money into good money, or bad expenses into good expenses, so that you can save money on your taxes, reduce your tax bill, and generally increase your overall tax wealth. So hi, my name is Steve Hunt, and I am a certified public accountant, and I'm the consultant for prosperity and adventure. I am the expert at helping you reach your dreams faster. I'm also the owner of collegetaxrefunds.com, where we help recent college students and their parents and families to claim thousands of dollars that they don't even realize they missed on their old tax returns. So if you have a recent college student in your family, please have them check out collegetaxrefunds.com to enter some numbers off their old taxes and see if they missed money, and then we can help them claim that money that they missed. It's usually thousands of dollars if they had scholarships or grants. Now, as I said, today we're doing our fourth and final video in a short series about tax planning strategies. And while I am giving you specific examples of tax planning strategies that you can use to reduce your taxable income and save money, I really want to help you understand why these tax planning strategies work. And so if you haven't already watched the first 3 videos, there was the first video doing an overview of tax planning strategies, why it's important to use your tax advisor, your CPA, your consultant for prosperity and adventure to help you save on taxes. And you want to talk to them about this throughout the tax year. You don't just want to hire your CPA to do your taxes February to April. I know that's when most of us want to focus on our taxes. That's the only time we ever want to think about taxes, and we don't want to think about it the rest of the year. But the problem is, if you only think about taxes when taxes are due, you're going to just pay whatever you owe, and it's going to be too much. If, however, you're thinking about taxes throughout the year and you're entering into transactions and accelerating your income or deductions or whatever, all the other things I've talked about in my other videos, throughout the year, you're going to save on your taxes when tax time comes. So you definitely want to be talking to your CPA throughout the year. Now, the second video was about income timing, where you accelerate your income or your deductions into this year, if that's what you want to do, or you defer them into next year. It's all about picking the right tax year, because not all tax years are created equally. The third video was about income shifting, where you shift some of your income to your children or your parents or to some other business that you own, or even to the charitable organization that you were planning to give money to anyway. And by shifting your income to these other people and entities, you reduce your overall tax bill. And again, this is because not all taxpayers are created equally. Some taxpayers pay at a higher rate and some pay at a lower rate. And if you, in your business, are in many different jurisdictions, you will have parts of your business that pay at a higher rate and parts that pay at a lower rate. So again, shifting your income was that third video, talking about the income shifting strategy. Today, we're talking about our third and final strategy in this last video, which is conversion. This is converting the type of income that you earn into a different type of income, or converting the type of deduction or expense, say a non-deductible expense, into a deductible expense. And this is because not all activities that you may be involved in are the same. Some activities create income that is taxed at lower rates. Some activities create deductions that you can deduct on your taxes, while other activities, other times when you spend money, you don't get to deduct that money. So we're using tax planning strategies to find the preferred activities, the preferred income, and the expenses that are in fact deductible. So let's talk about some examples of the conversion strategy. The first one would be dealing with self-employment. So self-employment income, some of you may know as abbreviated SE income. This is income that is taxed because you earned it on your Schedule C as a sole proprietor, or maybe because you earned it as the owner of a partnership. And self-employment income is one of the worst kinds of taxable income. Earning money as a self-employed individual is one of the worst taxable activities, because you pay not only your income tax, you pay what's called self-employment tax, which is the Social Security and Medicare portion that normally an employee pays and an employer pays. It's like 15.3% for most people. It's an extra 15.3% tax on all and every dollar of self-employment income. And you don't pay that tax on a dollar of, say, interest income or dividend income or rent income or whatever. So the strategies for reducing your self-employment income, there are two of them that I'm going to mention in this video. One of them is converting your self-employment income into wage income plus owner draws. Now, if you talk to any CPA, most of them are going to know exactly what I'm talking about here. This is where if you had a sole proprietorship, a Schedule C, and let's say you're earning at least $40,000. It should be more than that in order to make this worth your time, this method of conversion, and in order to make it worth the cost. But all $40,000 of taxable income on your Schedule C is taxed at your normal taxable income rate and the self-employment tax rate. Now, if instead you take that $40,000 and you report it, let's say $50,000 for the sake of our example. All $50,000 was at self-employment rate and at your normal income rate. Let's say that you take your Schedule C sole proprietorship and you turn it into an S corporation. This is a business that is also taxed at your income rates, but now it's a corporation. It's a separate entity from you, and it's being taxed under different rules. And while you have created a business that is an S corporation, you decide to pay yourself wages or a salary. And let's say that a reasonable salary for what you do in that company is about $40,000. At this point, your business, your S corporation that's making $50,000, is paying you a $40,000 wage. And the other $10,000, it's just reporting to you as an owner draw, as income because you own the S corporation. Now, this makes sense if your S corporation is making money not only because of work that you're doing, but because of some product that you built and is being sold online, over while you're sleeping even, or maybe because you have employees who are also earning money for your business and you've already paid them before you got down to that net $50,000. So the point is, some of the money you're earning is because you're actually working in the business. Let's say that's the $40,000 reasonable wage. And the other $10,000 is coming to you because you own the business. And the tax code treats income that you earn as an owner of a business better than it treats income that you income that you receive as a worker. I hope I said that right. I apologize if I didn't. Let me say it again. The tax code treats income that you receive as the owner of the business better than it treats income that you receive as an employee or a worker in the business. It also treats either of those better than self-employment income. So by taking your sole proprietorship and turning it into an S corporation, as long as you have, like I say, $40,000, $50,000 or more, and you can pay yourself a reasonable wage, you can reduce the amount of your self-employment tax. You'll also have to file a new tax return, an S corporation tax return, so that might cost you more money paying your accountant throughout the year, but you are saving money on your taxes. And if you watch the first video I did, you'll see that when you pay your accountant to do something for you that saves you money on taxes, that's better than paying, say, a marketer or an advertiser to do something that creates the same amount of taxable income. Anyway, this is one method of converting your income from self-employment income to wages plus owner draws. Now, another method of getting away from self-employment income is paying yourself some rent. You want to talk to your CPA about how to do this, but let's say you have a sole proprietorship where all $50,000 you earn during the year is reported on Schedule C and you got to pay that self-employment tax. Another way to avoid paying self-employment tax on the entire $50,000 is if you set up the business so that you also own, property, or and that it could be real estate, or it could be other property that your sole proprietorship rents from, say, the other LLC that you own. And that other LLC that you own owns the property, and it reports its income on a Schedule E on your tax return, rental and royalty income. And now your Schedule C sole proprietorship pays rent to your Schedule E rental business, and you report some of the income instead of as self-employment sole proprietor income, it's now deducted from that business and it is reported as rental income on the Schedule E. Rental income is treated better than self-employment income. And this is why we're converting your income from self-employment income to rental income. All right, let's talk about another method of converting bad to good. And this is converting wage income into non-taxable benefits. Okay, so wage income is one of the next worst treated income types in the tax code. When you get income from your boss, you got to pay the full income tax. There's not any preferred rates. And you also pay some Medicare and Social Security on that. That's basically half of the self-employment tax. So if you can get your boss to pay you in things other than taxable wages, you are converting the money into something valuable to you that isn't taxable. For example, you can divert some of that money into an FSA, a flexible spending account, or an HSA, a health savings account. And then you can use that FSA and HSA money throughout the year on your personal health expenses, which, I might add, your personal health expenses might not normally be deductible expenses because maybe you don't itemize your deductions or you don't have enough medical expenses. And so those are expenses that you're going to spend anyway, but you don't get to save any tax on them. But if you get your boss to, instead of paying you wages, to put it into your flexible spending account or your health savings account, and now you pay your medical bills from that, you can save money by not paying tax on that income, on those wages. And it's just like as if you had deducted the medical expenses. This is a way to convert bad expenses into good, or to convert bad income into good. You can also get your boss to pay you like in education. Maybe you want to take some night classes and they need you to take night classes so that you can gain, more knowledge about what you're doing. And that can be a benefit that they pay for you, and you're getting that benefit, but you don't usually have to pay tax on that, and they still get to deduct it. You could also get them, let's say you work for an airline, or let's put it this way. You don't yet work for an airline, but you love to travel, and you would like to, instead of having to work for $100,000 and pay tax on it, and then go spend that money that's already been taxed on flights, maybe you go get a part-time job for an airline, and your flight benefits, you now get to fly for a very much reduced price. Your boss is giving you, instead of giving you money, they're giving you flights, and you don't have to pay tax on those flights, at least not a lot. So that's another example of finding a way to go from making a lot of taxable income to go into making flights. It's like working for peanuts, but if you really, really wanted those peanuts and you were going to spend your money on peanuts anyway, it can be better to work for peanuts, basically working for flights. So that's an example of converting in order to avoid paying tax. You can also convert your short-term gains into your long-term gains. Now, a lot of you might be familiar with this method of conversion. This is where you have an investment that you've held on to for, let's say, 11 months, and you're about ready to sell it, but you're talking to your CPA about ways to do better tax planning, and they say, wait, don't sell that yet. Wait one more month. And let's say you've gained a lot of money on that investment. And yes, this is a little bit risky because maybe the investment's going to drop. You got to talk that over and decide what's best. But if you can wait just one more month, or maybe you've held on to it for 11 months and 28 days. If you can wait just 1 more, 2 more, 3 more days, however, whatever, and get it all the way up to 12 months, now you know that you're going to get to pay the long-term capital gains rate, which is a much lower tax rate. And so this is called conversion from short-term to long-term gains. Now, some people think, isn't that a timing difference? We did a video on timing strategies, but this is not timing, because timing was about what year you pay the tax in. Whether you sell it on December 31st or January 1st because you want the income in a certain year. We're not talking about what year. We're talking about what type of income we want. Short-term gains, which have a higher tax rate, or long-term gains, which have a lower tax rate. So that's a conversion strategy, is to wait just a little bit longer. You also might want to convert your method of reporting scholarships and tuition into claiming education credits. And this is something I'm very familiar with because it's all we do at collegetaxrefunds.com. The idea that a lot of people report their scholarship and tuition when they go to college as offsetting each other. Well, I got $5,000 of scholarship, I had to pay $5,000 of tuition. Those two just offset, so I'm not going to report either one on my taxes. I'm not going to have to pay tax on my scholarship. I'm not going to get to use my tuition. It's an offset. But that's usually not the best way to do it. You might want to convert that practice into claiming the education credits. And the way you would do that is by reporting some, not all, of the scholarships in your taxable income. And you pay extra tax on that, which usually isn't very much because you're a poor college student. But it's also possible that you might not pay any tax on that, because what happens now that you've included some of your scholarships in income, is you get to claim the tuition as a qualified tuition expense and claim the education credits, the very valuable education credits, like the American Opportunity Tax Credit. And so that credit can be worth up to $2,500, and the tax that you pay on your scholarship is likely not going to be nearly $2,500. For example, again, back to our example of $5,000 in scholarship, $5,000 of tuition, you might want to include $4,000 of scholarship in your income. And let's say you have a 10% tax bracket, you're going to only pay $400 in tax for including $4,000 of scholarship in your income. And you take your tuition, and because now you paid for some of it with taxed scholarships, you're allowed, based on other rules that I can explain elsewhere, I'm not going to go into it here, you're allowed to claim $4,000 as qualified tuition and claim the $2,500 education credit, the American Opportunity Tax Credit. Notice, you paid $400 of extra tax, you claimed a $2,500 credit. Way better to do it this way than to do it the way where you were just offsetting scholarships with tuition. And this is what the vast majority of college students do incorrectly on their taxes when they have scholarships and tuition. CPAs do it wrong, TurboTax does it wrong, all the tax software does it wrong. Basically, it just offsets the scholarships and the tuition, and that's not the best way to do it. We want to convert that into education credits. If you think you may have done that wrong in the past few years, check out collegetaxrefunds.com. We can still go back and fix your old taxes and claim the education credit for you. Another way to convert money is to take taxable interest. So interest that you're getting because you loaned money to a corporation. You bought bonds in a corporation, which is loaning the corporation money, and now when they pay you interest, you have to pay tax on that. You might consider buying bonds in a government, the federal government or your state or your city government, and loaning them the money instead. And then that interest is not taxable. Now, a drawback of this type of conversion is that usually your state and federal government pay you lower interest rates, but they're usually more dependable. And so it all offsets. And anyway, it may or may not be the best idea for you. Talk to your CPA about it. But it is one way to convert your income from taxable to not taxable. Another way is to convert losses, bad losses, into good losses. So there's such a thing as a passive loss, and those are often not deductible against active losses. So it's possible that you own interest in a partnership, and your partnership is just losing money. It's not doing very well. But you're not actually able to use those losses on your tax return to offset your taxable income. That's poor tax planning, because bummer, I can't even get the benefit of losing money through my partnership. But if you find a way to take an active role in managing that partnership, two things might happen. One is you become an active partner, and now you can deduct those losses against your income, your active income. And number two is that maybe because of your activity and your focus on the business, you might actually turn it around and start making money. So that's one way, though, to convert passive losses into active losses. Now, another conversion strategy is taking non-deductible dependent expenses and turning those into deductible wages. I already talked about this strategy in the last video where we talked about income shifting your income to your child by hiring your child as a legitimate employee of your business. And that is a shifting strategy because you are taking income that you would have to report on your taxes and shifting it to your child's tax return, deducting it as an employee expense on your business and putting it on your child's tax return, and they have a lower tax rate. That's income shifting, which we talked about last time. This time, I'm just going to once again mention that if you were already paying for your child's clothes and shoes and their entertainment and their rent if they live away from home and their car and transportation and all of their other daily expenses, everything that you spend on that dependent child is typically a non-deductible expense. You can't get any tax benefit for it. But if we go ahead and tell the child, you're going to pay for all of that out of your own wages, now you're deducting the wages that you pay the child because they're doing work for you. It has to be legitimate. Talk to your CPA about making sure that when you hire your child, you're doing it legitimately and following all the rules. But now you've taken those dependent expenses and made them deductible wages. And so that's another method of using conversion to, to turn non-deductible expenses into deductible ones. All right, the last one I want to talk about is converting your personal expenses into business expenses, such as your home office, your travel expenses or meals, that kind of thing. A lot of people really want to do this. They're always asking their CPA, can I write this off? So many people are really familiar with this tax planning strategy, but they don't actually tax plan for it. They simply, at the end of the year, they come to their CPA and they say, hey, I went on this trip to Hawaii. Can I deduct that? I had a home office, but I didn't really work from home or whatever. I didn't follow all the rules. They like to say, can I write that off? Can I write off this meal I had? And the way to do this correctly would be to plan in advance to follow all of the rules. And so that you're actually deducting, say, your travel miles and your hotel lodging and your flights to Hawaii and your meals when you're eating out and your home office. You need to follow the rules by setting all this stuff up in advance and knowing how to make these things deductible. For example, if you're wanting to go to Hawaii, make sure that you figure out a way to meet with someone while you're there who is someone that will greatly help and enhance your business, maybe a customer or a client or a real estate agent or somebody that you can only meet with in Hawaii. And so you now have a business reason for going to Hawaii. Now, you're not going to get to deduct your whole vacation. You're not going to get to deduct your snorkeling and your scuba diving. You're not going to get to deduct the flights, the expenses for your spouse and all of your children. And you're not going to get to deduct 7 nights of a hotel when you only met with the person for 1 day. Okay? But you're going to get to deduct some part of that travel, possibly your own flight and your own hotel for 1 night and your rental car for 1 day and maybe 1 meal where you sat down and met with that person because you had an actual business reason for being there and doing that business thing. But that's only going to happen if you plan it in advance. And the same is true with your home office. You can deduct a part of your mortgage or your rent and a part of your utilities and a part of your telephone expenses and a part of other equipment and computers and things that you bought for your home office, but only if you follow the rules for a home office. Normally, we all have a home office pretty much, and we all pay rent or mortgage and we pay utilities and we pay for computers and things, but most of the time those aren't deductible. But if you plan with your CPA how to have some kind of a business that you're operating from your home and you have a home office that is the location of that business, now you can make some money on the side and deduct your home office. And so you've converted your bad personal expenses into good deductible business expenses that allow you to make money that you can bring into your home, essentially tax-free, because you're offsetting that income with your home office expense. The same with your business mileage. It's only deductible if you're tracking it. So you want to do some good tax planning in advance and use apps like MileIQ to track your mileage and record your business miles. And also your meals. Again, you want to have a business purpose for going out to eat, and then you're going to get to deduct at least half usually. And in fact, right now, and this is very special, if you're watching this video in 2021 or 2022, during these 2 years, Congress has said that 100% of your meals expense, your business meals expense when you're eating out at a restaurant is deductible, so long as you have a business purpose. So if you take somebody out to lunch or dinner in order to work on your business, in order to close a sale, then you get to deduct the full amount of that meal in 2021, 2022, when normally you only get to deduct half of it. And that's, you only get to deduct half if it's a business expense. A lot of the time we go out to eat and it's not even business related. So planning to have these kinds of business expenses is converting bad expenses into good. So hopefully you catch the idea behind this tax planning strategy of converting bad activities into good activities. And when I say bad and good, I'm not talking about morality. I'm talking about, activities that get preferential tax treatment is what you want to be doing. And you're only going to be able to do that if you talk to your CPA about how you can improve your business activities to make more expenses deductible and to make more of the income non-taxable, or get it taxed at a lower rate. Thanks so much for watching these 4 videos about income tax planning strategies. I hope you learned a lot about why tax planning strategies work. There's the timing method, there's the income shifting method, there's the conversion method. If you have any questions about these strategies or about taxes, I invite you to put the questions in the comments below. I'll try to answer them. If your question is a big one and important, I may even make a video about it. Thank you so much for subscribing, liking the video. Have a great day.